In this video, we'll learn more about how banks trade and learn the bank strategy. This is very important information that will help every trader, no matter your strategy or your trading style. Make sure you stick up to the end to understand how banks make money out of your pockets. Firstly, how do banks buy and sell? In every bank that participates in the trading of securities, that is trading Forex and other tradable assets, they have a department that analyzes these assets. Firstly, banks do not use leverage like us retail traders, but use one-to-one for every transaction. That means they actually have a large amount of capital that can allow them one-for-one for every smallest movement within the markets. However, when they buy or sell, let's say Euro USD, they cannot just press buy or sell like what we do. If they do so, their orders will not be filled. The same experience you do when you try to buy or sell whilst there is NFP release. For them to buy or sell, they need retail traders to buy from or to sell to. So basically, since trading is a two-way process, for you to buy, there should be someone to sell to you, and for you to sell, there should be someone to buy from you. So likewise, banks, since they have access to large amounts of capital, they need someone to buy from or to sell to. So this calls for what we call interbank cyclic trading, right? What is it? Interbank cyclic trading work as Bank A, let's say there are two banks. Bank A buys the asset, right? They buy, and that buying will induce masses, leading to the market actually rising. Then another bank B will actually be in the same path as bank A. They will actually sell it with higher contracts. For instance, let's say bank A is bought with 5 lots. Bank B will actually buy will actually sell with 10 lots at the right price to counter the flow, right? To counter the flow. So bank A will start to see its profits decreasing. Bank A will now close its contracts at its entry point and joins the ride, right? So Bank A and Bank B are now in for the ride, whilst the retail traders have been used to introduce liquidity. So just to repeat what I've said, Bank A buys the asset to induce the masses. Bank B sells with higher contracts at right price to counter the flow. Then Bank A close contracts at entry price and joins the ride. So to interpret this, it's a bit difficult, but we'll try to simplify it with the strategy that we've created. So the other thing that you should know is banks are responsible for what we call order blocks. This arises within the markets if, for example, one, Bank A buys. If they buy at this point, they do not buy with the whole chunk of contracts they wish to have within a particular flow. Then two, Bank B will sell with double contracts so that it actually reverse the market or counterflow the market. Then at this initial price where Bank A has bought, it will be able to add more positions, whilst Bank B closes the sell that they've actually rode from this point to that point and now buys. However, when this is done, and if retail traders are not so much enough to satisfy the required volume, they'll actually go beyond this lowest point, and this is called gap filling. They will fill this gap as a way to induce more traders so that they introduce enough liquidity for them to ride up with the markets. Before we talk on the simplified explanation of the bank strategy, check out our free community. We have a free Signals Telegram channel, and I'll leave the link in the description box below. So to simplify everything we have talked about, we can illustrate it as the first thing that we see on the markets as a way or on how these banks are involved, so that we do not talk of very complex stuff. We would say the first thing to appear on the markets is break of market structure, which is basically breaking of the recent high or the recent low, depending on the market context. If we see break of market structure on the second low, third low, or fourth higher low, depending on where they want to actually introduce more contracts, we will see creation of a gap which will then be filled. That gap will actually we can enter within that gap on the lower time frame candlestick reversal pattern. This is done in a way whereby it's not as easy like this to see on practical markets. So here's how it looks like on real markets. The first thing, as you can see, there was break of market structure. After break of market structure, whilst they still wanted to continue with an upward trend, we can see that they actually made a gap. Then at this point, you can see that right at this point, they made a candlestick reversal pattern to induce traders, right? But there were not enough people for them to continue with the trend. Therefore, they had to fill this gap and actually give us an entry point within this particular trading strategy as a gap fill. From there, we can see the market now went in an upward direction. After that, the market broke structure, right? It broke structure. This was the low, and they created another low, which means breaking of structure. At that point, we created a gap, right? Which we later came back at this point to actually grab the liquidity that was available. At this point, we need a candlestick reversal pattern on the lower time frame. We can as well see that continuing with the downward trend, the market came back, created this high. But this high was there as a way to introduce liquidity, which was then grabbed later. So it's basically breaking of structure, creation of gap, filling the gap, and entry. So to remember, we are saying breaking of structure, creation of a gap, filling the gap, and we move on with the trend. So breaking of structure, creation of a gap, clearance of the liquidity, and we go forth. Basically, that is a simplest interpretation of everything that we were talking about earlier before on how banks actually make money out of your pockets. So this is something that makes trading a little bit more difficult, but you need to be always particular with what you are doing in your trading. On that note, we come to the end of this video. Thank you for watching. Like and subscribe. Check out our free Telegram channel. I'll leave the link in the description box below. See you on the next one.